Imagine you're walking through a massive gallery of 500 beautiful paintings, thinking you've invested in a diverse collection that protects your future. But as you look closer, you realize that 400 of those frames are actually empty, and the 10 largest paintings in the room are the only things holding up the walls. This is the reality of the S&P 500 today, and it's the reason I am completely rewriting my investment playbook. For decades, the low-cost index fund was the gold standard, a passive safety net that returned 10% a year by spreading your bets across the top 500 companies in America. But AI has changed the physics of the market. Right now, for every single dollar you put into the S&P 500, 40 cents is funneled into just 10 companies. We are talking about the giants: Nvidia, Microsoft, Apple, Alphabet, and Meta. In fact, Nvidia alone now claims nearly 8 cents of every dollar you invest. Because the index is market cap weighted, the more expensive these stocks get, the more of your money they demand.
But here is the $2 trillion question. Can they actually deliver? To justify their current prices, these AI leaders would need to generate roughly $2 trillion in revenue, which is more than the combined annual revenue of Nvidia, Microsoft, Apple, Alphabet, Amazon, and Meta in 2024. Investors aren't buying these stocks for what they earn today. They're gambling on what they might earn in a future fueled by mountain loads of debt. We're seeing a massive feedback loop where these giants pass money back and forth to each other, creating a mirage of economic strength. Some data even suggests that without this frantic AI spending, the U.S. economy would already be in a recession. You might think the exit strategy is simple. Just switch to an equal-weighted fund where every company gets a fair 2% slice. It sounds like the perfect safety net, but it carries a hidden trap called negative momentum. In an equal-weighted fund, the moment a company like Tesla starts to take off, the fund is forced to sell those winners to buy more of the losers, just to keep the scale balanced. This constant trading creates high costs that eat your gains and stops you from riding the biggest waves of growth. This is why I'm keeping my core holdings, but diverting all my new capital into a different strategy. History has a very clear message for us. No empire stays on top forever. If we look back to 1900, the United Kingdom was the undisputed global superpower, holding 24% of the world's stock market. Investing anywhere else would have seemed insane. We saw it again in the late 80s with Japan's explosion in electronics and cars. Everyone thought Japan was the future, while the US was struggling with inflation and slow growth. But the layers of the global market cake are always shifting. By only sticking to the S&P 500, you are completely locking yourself out of global giants like TSMC, Samsung, and Toyota simply because of where their headquarters are located.
To fix this, I am moving toward global funds like VWRP, which give me instant exposure to nearly 3,800 companies across 45 different countries. The beauty of a global fund is that it rebalances itself. If the U.S. dominance fades and a market like India or China begins to lead, the fund adjusts automatically. It's a way to ensure I'm not just betting on one country, but on the entire world's growth, all for a tiny fee of about 0.19%. When I look at the market today, I see it divided into 4 distinct zones. There's the crowded zone, where everyone is piling into expensive stocks like Nvidia and Meta. Then there's the defensive zone, the reliable cash cows like McDonald's and Walmart that keep making money regardless of the economy. In the corner, you have the speculative zone, filled with hyped-up companies like Peloton or AMC, which I personally view as more like gambling than investing. But the real treasure is in the overlooked zone. Right now, the tech giants are in an AI arms race, spending billions to build the best models. But AI models are becoming interchangeable. Soon, users will just pick whichever one is cheapest and most effective. When technology becomes a commodity, the value doesn't stay with the people who built it. It flows to the underdogs, the small and mid-cap businesses that use AI to solve real problems without carrying billions in debt. These are the companies I am backing now. Every major technological leap brings instability, and that is why I am also significantly increasing my gold reserves. I'm not the only one. China has been buying gold at record levels, building a gold corridor to bypass the US dollar and trade with nations like Brazil and Russia. For the first time since 1996, gold has actually overtaken US Treasuries as the world's largest foreign reserve asset for central banks. The reason for this shift is a major rule change. Gold is now a Basel III Tier 1 asset. This means banks can now treat gold exactly like cash on their balance sheets. Previously, they couldn't count its full value, but now institutions are being told to increase their gold reserves from 20% to 30%. You can't print more gold, so this massive surge in demand is a powerful hedge against a system under pressure. I hold physical gold as insurance and use gold ETFs for the flexibility to move my money when I need to. Finally, I'm watching the moves of the greatest value investor in history, Warren Buffett. As we move through 2025, Buffett is sitting on a staggering $347 billion in cash. He isn't betting against the world. He just doesn't see enough opportunities that justify the current high prices. I am following his lead by holding more cash. Having a cash reserve prevents you from being forced to sell your stocks during a panic. But more importantly, cash is dry powder. It is the power to buy when everyone else is terrified. The truth is, I don't need to be a psychic to build wealth. I just need to be prepared. I'm staying in the market to catch the growth, but I'm building walls of global diversification, gold, and cash to protect myself from the bubble. Don't just follow the crowd into the gallery. Make sure you're the one who owns the walls.